Hello, I'm Dieter Scherer, the only financial planner and founder of RealizeYourRetirement.com. This video is part of a series called Foundational Finance, where we'll go over the basics you need to know to get up and running in investing and begin to speak the language of finance. Foundational Finance is a part of Retirement Planning Academy, a free course I offer on RealizeYourRetirement.com. Today's video covers bonds, what they are, how they provide returns to investors, and how people commonly invest in them. A bond entitles the owner of the bond to a fixed payment called a coupon every year for a certain number of years. They're called coupon payments because bonds used to come with a sheet of coupons that you would have to cut off the bond and send into the company each year. The term of the bond is the number of years over which a company will make you interest payments, which are called coupon payments. So a 30-year bond with an annual coupon will send you 30 interest payments, one for every year in the term. The face value of the bond, usually $1,000, is the amount that was originally lent to the company. This is commonly also called the par value of the bond. The end of the term is called the maturity of the bond, and that is when the bond matures and the company no longer has to pay you any coupon payments and will send you the face value of the bond. Let's do a quick example. You purchase a bond from XYZ Corporation. The bond has a face value of $1,000 and it has a 5% coupon rate. Therefore, we multiply the face value of the coupon or of the bond by the coupon rate to yield a $50 coupon. A $50 coupon entitles you to $50 per year in interest payments. Here's how a bond investor's return would work. A bond's return is made up of the interest payment or coupon payments of the bond and also the price appreciation of the bond. First, we'll look at how the interest payments affect returns, then we'll cover price appreciation in a moment. Here we have a bond that was purchased for $1,000 with a 5% coupon and a face value of $1,000 and a term of 1 year. We'll add the coupon payment of $50 plus the face value of the bond of $1,000 and then subtract the $1,000 that we paid for the bond. So the face value and purchase price cancel. We divide the answer to that, the $50 coupon payment, by the original price of the bond of $1,000, and we're left with a return on the bond of 5%. So the price of previously issued bonds is affected by the level of current interest rates. Basically, there's an inverse relationship between price and interest rate, and this means that they move in opposite directions from one another. So I'll use the classic example of a seesaw to illustrate how this works, with price on one side and interest rates on the other. So when interest rates go down, prices go up. As you can see on the seesaw, as one goes down, the other must go up because they're linked. They both can't rise or fall at the same time. Well, why is that? Well, bondholders want to be treated fairly when they're buying and selling bonds. When they sell a bond, they want what it's worth in today's environment. Say I have an old bond that I purchased last year, and old bonds have a 5% coupon rate, and new bonds only have a 3% coupon rate. So my bond pays me more each year than new bonds do. So my bond has a more attractive interest rate and it's worth more than new bonds because on a $1,000 bond, my bond would pay me $50 a year, whereas the new bonds would only pay me $30 a year. And because it pays me more each year, the price of that old bond will increase. Now let's look at what happens when interest rates rise. So when interest rates go up, the seesaw shifts again because both price and interest rates cannot go in the same direction. So when rates go up, prices go down. Let's take another look at the reasoning behind this. Let's say I have an old bond and it has a coupon rate of 3%. New bonds have a 5% coupon rate. Well, if I bought my old bond for $1,000 and it pays me $30 per year, and we can all buy new bonds for $1,000 that pay us $50 per year, well, my bond is worth less than the new bonds because mine is going to pay less than new bonds. So if I sell my bond, it's going to be worth less than the $1,000 I originally paid for it. Therefore, prices of old bonds decrease. Price appreciation is the return you receive when a bond increases in price. Losses would be considered price depreciation. If you hold a bond until maturity, you'll receive its face value. But if you sell a bond before maturity, you'll receive the price the market is willing to pay for it. So in this example, interest rates decrease. And we're not going to hold the bond until maturity. Instead, we're going to sell it. So we purchase the bond for $1,000, and the decline in interest rates causes the price of the bond to increase from $1,000 to $1,100. The bond also has a $50 coupon, and we're only holding the bond for 1 year, so we'll include a single payment of $50 in the calculation as well. So here we have the $50 coupon payment plus the new price of the bond of $1,100 minus the purchase price of the bond of $1,000. And finally, we divide that by the price of the bond of the purchase price of the bond of $1,000. So $1,100 minus $1,000 equals $100. And $50 plus $100 equals $150. And if we divide that by the original purchase price of $1,000, you see that the bond returned 15%. So, how do you invest in bonds? Bonds can be purchased individually or through investment funds like mutual funds or ETFs. And the bond market is less liquid than the stock market, meaning it's not as easy to make trades, so investors typically invest in bonds via mutual funds or ETFs. This is primarily because most bonds are still negotiated via brokers instead of an online exchange. And mutual funds and ETFs will either buy bonds based on certain criteria they have set, or they buy bonds based on whether those bonds are in an index. And for an example of an index, the widely reported Barclays U.S. Aggregate Bond Index attempts to purchase almost all of the largest bond issues in the United States, both from the corporations domiciled in the United States and the U.S. government. Other funds may choose specific criteria when selecting bonds in an effort to reduce risk or increase returns. In the event of a liquidation bankruptcy, the company's assets are sold and used to pay the claims of lenders and shareholders, and they're usually paid in this order. First paid are the debt holders, those who have bought bonds, and they're paid as much of the balance of the debt as they are owed, as well as any interest they are owed. Next, if there are any funds left over, holders of preferred stock are paid their dividends, and finally, common stockholders are paid whatever remains. And when you buy a stock, you generally buy a common share of stock. So bondholders are generally they get the first shot at the assets of a company during a liquidation bankruptcy, because bondholders have a contractual obligation from the company to be repaid the value of the bond. And the assets of the company are sold off, and bondholders receive as much of their bond value as the companies can pay them. Companies with a lot of debt may not be able to pay every bondholder the full face value of their bonds, whereas companies with little debt and lots of hard assets are in a better position to do so. If you'd like to learn more about the basics of finance, watch these other videos in the Foundational Finance series. And if you want to learn more about investing, sign up for my free course, Retirement Planning Academy, by visiting realizeyourretirement.com. Inside, we'll discuss how annuities actually work, how value investing and tactical asset allocation can help you reduce risk and increase potential returns, how to maximize your Social Security, and how to make smarter retirement planning choices. You'll also get access to exclusive tools and calculators that I've built just for members. To sign up for this free course, just go to realizeyourretirement.com. Thanks for watching and have a great day.